simply put, we're looking at 19 out of 20 South African fund managers having delivered results below the market index over 20 years. And that really gets one thinking about how good fund managers really are to begin with.
Yeah, I think you're right. A lot of people do wonder that. But the real question is that in aggregate, active managers trying to beat the market are fighting for a zero return. That's the excess return that's available to all investors is zero. So for every winner, there's a loser. And no matter how good the active managers are collectively, on average, they can't all beat each other.
Having said that, though, I mean, the ratio does improve as the period decreases. So how realistic a framework is a 20-year timeline?
I think the first point is that alpha, that's what all active managers try and chase. So if we look at the all-share index, in 2010, it returned 19% was the total return. So what an active manager is trying to do is add alpha to that. They call the 19% the beta. And in aggregate, alpha is zero. That's my point. So for every winner, there is a loser. That's before fees. So once you factor in fees, it becomes a losing game for most investors. And the reason why the performance is better in the short run is that the fees are much more significant over time. So it's possible for funds to do better in the short run, but in the long run, once you compound the fees, and the probability of outperforming your peers just diminishes. So the probability diminishes, and you keep on incurring the 1 or 2% in fees, and that leads to greater performance the longer your time horizon. And just lastly, your point, 20 years is relevant because investors are long-term. So if you're trying to save for retirement or for your child's education, typically that's a long-term horizon, and we all focus far too much on the short term without seeing the bigger long-term picture. When
looking at factors to consider for the kind of performance that comes through, it's of course those costs associated with actively fund managers that comes to bear, and certainly that's cropped up in your answers so far. To what extent is this the big bugbear, if we can call it that?
Well, ultimately it's cost. Ultimately the market is going to deliver a return to investors, but investors don't earn the market return. They earn the return less the total fees paid for intermediation. And active managers are an important fee, but by no means the only fee. They have to pay for distributors, they've got to pay brokers, advisors, asset managers, product developers. And I think that's the main criticism certainly we would level at the industry, is there's just too many fees. And in aggregate, those fees are just too high for most investors to bear.
Costs aside, I mean, crystal balls become even rarer a commodity in volatile times, Stephen, making beating the markets or effectively timing it a little more tricky as well.
Yeah, without a doubt. I mean, you know, everyone has an opinion, and every time a share trades, someone's right and someone's wrong. And both people trading are probably intelligent. So it's very difficult over the long run to beat the market, and it seems difficult now because of a lot of volatility. But the truth is that even when there's less volatility, you've still got to outsmart the market, and the market is the collective wisdom of all the smart people. It's already there. It's already set in the market price. So it's a very difficult undertaking in volatile markets and also in calm markets.
So this scenario then coming to bear on those retirement packages quite a bit. I read in the report that an estimated 94% of South Africans do not have the adequate financial resources at retirement phase. So what are the options that we're looking at for change here?
Well, there's two reasons for the very high failure rates. We can't just blame the industry. The first is people simply don't save enough. As a rule of thumb, you should save 15% of your total earnings for 40 years. That's the first thing. So people need to become good savers, disciplined savers. Secondly, we believe that the industry needs to reform quite a lot. They're offering way too many options. Those options are expensive, they're complex. They create the need for advice. People change. As you say, in a volatile market, do I change my portfolio? It's more advice, more fees. And at Tenex, we believe people need sensible solutions. There's too much product that's being sold. Clients need a solution to see them through to retirement or to whatever their investment goal is. And that solution must be delivered in a very low cost and transparent way.
So what's on your radar then in terms of an index fund that is looking attractive or where that value is appealing?
Well, what we do is we manage each individual based upon their time to retirement. So the younger they are, the more equity exposure they've got, so they can withstand the short-term volatility for the higher long-term returns, because equities deliver the highest returns over most, if not all, long-term periods. But if you're close to retirement, then the volatility is a big risk for you. You can't recover. You don't want to expose 30 years of good saving trying to chase that last bit of return. So that's what we do. We manage each person individually, whether they're in a large corporate or they're an individual in a retirement annuity, and then we minimize costs. Once we've got the right portfolio, that risk-appropriate portfolio, it's about cost minimization. How do you do that? Don't pay active managers. Get the market return. You're going to beat most, not all, but most active funds. We don't use brokers. You don't have to pay broker commissions, and we have very efficient systems because we're not managing 30, 40, even 200 products. We're managing one product. So the investor fees that they pay are dramatically lower, well less than half the industry average.